All right, let's talk about something you hear all the time when you're thinking about buying a house, the conventional low.
So, have you ever been in a conversation where someone throws out that term and you just kind of nod? Like you sort of know what it is, but if someone asked you to explain it, maybe not so much.
Well, you're definitely not alone, and we're going to fix that right now. In the next few minutes, we're not just going to master the essentials, we're going to give you some super simple ways to remember them for good.
First things first, what even is a conventional loan?
Okay, so at its very heart, it's pretty simple. A conventional loan is just a mortgage that is not backed by the government. That's it. It comes from private lenders, your local bank, a credit union, a mortgage company. It's the standard, the conventional way to get a home loan.
And a great way to understand what something is to know what it isn't. So you've got government-backed loans like FHA or VA loans on one side. They're insured by the government. On the other side, you have conventional loans. These follow the rules set by two giants in the mortgage world, Fannie Mae and Freddie Mac. Think of them as the rule makers for the private loan market.
And that brings us to this awesome analogy. You'll hear the term conforming loan thrown around. All that means is, does the loan fit in the box of rules created by Fannie and Freddie? If your loan application checks all their boxes, the right size, the right shape, it conforms. If it's too big, say for a really expensive house, it's called a jumbo loan, and it's non-conforming. Simple as that.
So what are the rules of this box? What do you actually need to qualify? Let's break down the 4 big ones you absolutely have to know. Okay, first up, a number. Just one number to start with, 620. What's so special about 620? Well, that's pretty much the magic number for your credit score. It's the standard minimum FICO score that most lenders are looking for. Now, a higher score is obviously going to get you a better interest rate, but 620 is your ticket to get in the game for a conventional loan.
All right, next up on the checklist, your debt-to-income ratio. You'll hear this called DTI all the time.
So DTI is basically a percentage that shows lenders how much of your monthly income is already going towards paying off debt. They look at 2 numbers. The front end is just your new potential mortgage payment. Lenders like to see that below 28% of your income. The back end is the big one. It's your mortgage plus all your other debts, car payments, student loans, you name it. The sweet spot for that is under 36%. Now, for strong applicants, some lenders will stretch this up to 45% or even 50%, but that 28-36 is the classic target you want to aim for.
Okay, let's talk down payments. And this number might actually surprise you. It can be as low as 3%.
Yeah, you heard that right. That whole idea that you need 20% down, it's pretty much a myth these days. There are special programs where you can get into a house with just 3% down. For most people, though, 5% is the standard minimum. But that 20% number is still super important because hitting that mark lets you avoid our next topic,
Which is private mortgage insurance, or PMI. Here's the deal. If you put down less than 20%, the lender sees you as a slightly higher risk. So to protect themselves, not you but them, they make you pay for an insurance policy. It just gets tacked right onto your monthly mortgage payment.
Phew, okay, that was a lot. We've got credit score, DTI, down payment, and PMI. But how are you supposed to remember all this? Well, this is the best part. Let's lock it all in with some really easy memory hacks.
To remember those 4 main requirements we just talked about, I want you to think of one simple phrase: CDC protection.
It works perfectly, right? C is for credit score, your 620 minimum. D is for DTI, that 28-36 rule. The other C stands for conforming, making sure the loan fits in the box. And P is for PMI, that protection the lender needs if you put down less than 20%. CDC protection, you got this.
Okay, what about the down payment numbers? For that, we have another super simple rule. Just remember the 3-5-20 rule. It goes like this: start at 3, thrive at 5, and you're free at 20.
Let's break that down. You can start your home buying journey with as little as 3% down, especially with first-time buyer programs. You'll thrive with the standard 5% that most lenders look for, and you're free from PMI when you hit that 20% mark. 3-5-20. See? Easy.
But what if you do start with PMI? How do you make it go away? Well, for this one, we have a fun little phrase. Just think 7-8 PMI. And that's 8 as in the number 8.
So what does that even mean? It's a trick to remember 2 very important percentages for your loan-to-value ratio. Once you've paid down your loan to 80% of the home's original value, you can actually call your lender and request that they cancel your PMI. But here's the cool part. If you forget, the law requires them to automatically cancel it when you reach 78%. Get it? 7-8. 7-8 PMI. It's gone.
All right, let's pull all of this together. You're not just guessing anymore. You now have a really clear picture of what a conventional loan is, and more importantly, you've got the tools to remember the key rules.
So, to recap your new toolkit, when you think about requirements, think CDC protection. When you think about your down payment, it's the 3-5-20 rule. And when you want to get rid of that extra monthly payment, just remember that 7-8 PMI.
You're no longer just nodding along in those conversations. You've got the knowledge, you've got the confidence. So the only real question left is, with all this unlocked, what's your next step?